From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It is Friday, February 17th, and you're listening to the Macrocast. I'm Bryan DeAngelis, a partner here at Penta, joined always by John Fagan and Brendan Walsh from Markets Policy Partners. This week, we're also joined by my colleague, Oliver Edelmann, a director here at Penta. And we're going to jump into some of the latest inflation numbers, what's going on with U.S. consumers, and we'll spend a little bit of time maybe speculating on what's happening with Biden's economic team in the Federal Reserve. But to start, maybe Brendan, kick us off. This week we saw some new inflation numbers, and I find it kind of interesting. You can sort of choose your own adventure. It's one of those ambiguous images. You might see good data, you might see bad data. It depends kind of on your view, but break it down for us.
Yeah, so we got two data points, the consumer price index, which was very much a choose your own path. And then later in the week, yesterday, we got the producer price index. So the producer price index was much higher than expected. And that one was fairly straightforward. Producer prices, don't have the quirks that the consumer prices. Right. The consumer prices was very much choose your own path, because while the number came in higher than expected, basically half of that was attributed to housing, which the way that the BLS measures the housing numbers, it's kind of a 6-month rolling average. So it's very lagged. And we do have, real-time data that we know that the housing market, really started to turn over 6 months ago. And all the data that we get, whether it's official data, like we did get building permits and housing starts, and those are continued to plunge. But we also get, the Zillows of the world and the Redfins that show us that, we're in deflation. Housing prices are going down. So the market basically kind of ignored the high consumer price index, because we know that it'll probably start showing up in the February, March, but it'll really be showing up in the summer months. That the housing component is going to really drag down the CPI. So the other components weren't too scary. The service inflation is still going up, but not at scary clips, and the goods deflation is still apparent. Though, and actually the experts in the car industry don't know exactly why used cars prices have started to go back up a bit, which that's something to watch.
It is. It's somewhat surprising, but yeah.
And then, the housing data is still pretty terrible. And actually the manufacturing data is still pretty terrible. But the rest of the data is very strong. Like retail sales came in very, very strong. Part of that had to do with December was really, really cold, and the December data was terrible. January has been like summer throughout the country. So people, one of the biggest contributors was actually food away from home. People went out to eat a lot. So I think we kind of have to, look at those two in conjunction with each other. But the consumer is still doing well, and all the labor data, the employment is still very strong. The unemployment claims are, fairly close to historical lows. So we have a very interesting economy where
it's still very hot, right? And
exactly, and the deflation might not be falling as fast as we had thought maybe a month ago. So the market, John, you have it probably at the tip of your fingers. So the market had been pricing the Fed to basically stop hiking at 5%, and then the summer months to start cutting. So certainly the market has repriced, how high the Fed's going to go. But what's happening in the out months, John?
Yeah, so essentially the past couple of weeks, it really kicked off with the non-farm payrolls print for January, where we got that blowout number, and then we had a period of digestion about that, and then we had this week it was the faster than expected CPI, PPI, and retail sales surprising on the upside, and so this has basically elevated what they call the terminal rate, where the Fed stops their tightening cycle, And over the past couple of weeks, that's moved a lot. It's essentially gone from sort of 5%, give or take 25 basis points, to more like 5.25% or 5.5%. And you see like Goldman Sachs, which tends to hug consensus, moving their forecast up to 5.5% after forecasting an additional 25 basis point hike in June. Let's face it, June's a long way away, right? And even further out, when you look at the futures market,
this week shows you that, like, just how quickly the market can reprice things.
Well, yeah, I think we'll talk about that in a little bit. I mean, the market is a little bit rudderless here. I mean, it's just chasing data points with that could be very idiosyncratic and outliers. And actually, Fed Chair Powell said that very same thing after the non-farm payroll number. He certainly could have taken the bait and been like, "Oh my gosh, the labor market's going crazy. We've got to go tight."
Incredibly important.
Do that. Yep. And he said, this is it's 1 month. We'll look at how the trend is going, but we see the trend materialize in this direction. He's doubled down on his view that inflation is just as, early as earlier this month, basically said the disinflation process has started. Is he going to come out and say, I was wrong, it's reaccelerated after one data point or a couple of, no, he's not going to do that. And that's a good thing. The Fed needs to have that firm hand on the tiller to look at the trends. And because the markets are going to overreact to these one data points at any given time, if they think the Fed is going to overreact to them. If the Fed is taking a relatively steady line and making consistent policy statements, the market is going to be able to digest that a lot better without slamming back and forth. And
if I'm the Fed governor, I'm less concerned about how high rates go. I'm much more concerned that I can hold them there and don't have to cut.
Yeah,
I was just going to ask that. Yeah, like we are.
One of the things that has survived this great, the reset higher in treasury yields, the reset higher in expectations for the terminal rate, what has survived that is expectations for easing later this year. Yeah. And so it's obviously expectations have, that the whole curve has sort of shifted up because of the expected, higher finish for where the Fed goes, but there's still, the futures market are still pricing in by later this, by the end of the year, sort of November, December, that the Fed will be back in easing mode.
So that's interesting. The market did reprice a little bit, but they didn't. They still kept the cuts. They just pushed it out a little farther.
That's right.
Yeah. So okay. So break that down for us a little bit, because I wanted to ask on that. So we're seeing, like, I don't know, the Fed doesn't have much more road to go. Like, certainly there are some hikes, but we're not going to get to a place of like 7-8% or something.
That would be shocking,
right? So this talk, I've always found it somewhat optimistic personally that we're going to cut at the end of the year. I mean, it feels to me like we're pushing into 2024 before we actually see cuts. Is that what you guys are seeing in the markets, or are they holding strong that it might be end of this year?
The markets are still showing cuts, a significant percentage probability of rate cuts by the December meeting, December 13th is that meeting. And essentially, is a full cut priced in? Maybe not. It kind of depends on where the terminal rate lands. But essentially, the expectation is that the Fed is going to be in easing mode, and it's going to start that by the end of the year, predicated on the idea that we're going to be in a recession later this year. And as even though the narrative has sort of shifted, and we're one retail sales month has sort of changed everybody's idea from hard landing to soft landing to no landing. We're just reaccelerating. We're going to touch and go and take back off again. That may be the case, but for every positive data point about the consumer fortitude, there's a but C. And this morning's but C was but C credit card debt spiraling to extreme highs. The expectation that the consumers on the lower echelons of the income scale are having a much harder time, and that sort of like cumulative effect of headwinds, of higher prices, of not eye-watering, but like elevated energy prices, elevated prices, just softens up the consumer, and they eventually sort of capitulate by year end, I think is still the base case based on what the Fed Fund future shows.
We also get credit card charge-off data on a monthly basis, and while it was at historic lows, the various trusts, from Bank of America and Capital One, they did pick up. So now they're over 3%. So nothing to freak out about, but that's how it starts. We start from a low level and slowly charge off. We also saw our first default in the commercial real estate sector. which that has a lot to do also with our socioeconomic pricing of how we work post-pandemic. But the commercial real estate sector is really hurting because people don't go to work on Mondays and Fridays.
We're here on Friday, but yeah.
On the credit cards, I thought it was interesting that kind of aggregate credit card debt is now at a higher level than pre-pandemic. And I think that was such a long storyline during the pandemic that folks were drawing or reducing their credit card debt kind of with that stimulus money and less spending. And now we're at that point again where aggregate debt is actually higher than before the pandemic. And rates, I think credit card rates or APRs are higher than ever before as well.
Yeah, well, National actually had a record year in 2022. It was higher than pre-pandemic. So people are spending that savings. It's gone, and now you're starting to have to borrow to go to Cancun.
Yeah, they're still spending. That's the thing.
Yeah.
But Oliver, let me.
But also, unemployment is at 3.5%, and you can get a job anytime you want. So. While it is a little troubling, we're not seeing any cracks in the labor market. So the three various CEOs at the big banks all spoke this week saying, our consumers, our clients are doing well. Like we don't see a recession. We don't even see a soft landing. We just see us keep going, keep flying.
Yeah. Brendan, at what point, and John, at what point when you see debt pick up again, and when you see, I know charge-offs are still quite low, but when you see them pick up again, at what point do policymakers start worrying about that? I mean, that folks can get a job pretty easily now, Brendan, as you just said. But at what point does it become a concern?
I think when it starts to show up in the labor data.
Mm-hmm.
Yeah, and I think also the weird thing about this cycle is it wouldn't be a concern. The Fed wants that. The Fed,
exactly.
Essentially, they may not want a recession, but they want the labor market to crack. That's what they keep saying.
Yeah. Oliver, let me thanks for jumping in. Let me bring you in here. So going back to the consumer and some of the data, we obviously, listeners know, release a biweekly economic sentiment index reading with our partners over at Civic Science. We did that this week. Why don't you break down some of those numbers for us and how it ties into some of this discussion?
Yeah. So at a top line, we saw increases across the board. This is the first time that all 5 ESI indicators moved positively in tandem. I think the first time since November of 2022. And so, we talk about the various indicators and the things that have come out between retail sales and the jobs number, the rate hike over the past 2 weeks. And, the question is, how has the consumer kind of responded to this? And the answer is very positively. I think we were pretty surprised at how fast it jumped. I think 2 weeks ago, John Dick was here talking about, the Long Island iced tea of things that consumers are digesting right now. And, if consumer confidence had gone down over the past 2 weeks, I think there would have been good reasons why. It's gone up, and there are also good reasons why. And I think that's just kind of the weird phase that we're in right now, where consumers are digesting a bunch of different stuff, and it's just a little bit all over the place. But I think we were very surprised at how, at least I was quite surprised at how strongly they responded over the past 2 weeks.
And correct me if I'm wrong, but this is very kind of forward looking on their confidence. I believe the questions are written of like, how do you feel about spending over the next 6 months? Yep. How do you feel about getting a new job in the next 6 months?
Yeah, exactly. And the spending in particular is interesting, kind of quickly going back to the credit card piece, because, the savings rates are down again to after this kind of pandemic induced bump. Credit card debt is up again. And yet folks still feel extremely confident in their spending going forward. Now, I will say, as we kind of parse out the data, over the past 12 months or so, as we take a look back, I like looking back how things have changed over the past 12 months. And we've seen, the major purchase piece along with the housing piece kind of like trundling along at the bottom there. And then confidence in personal finances towards the top. So it's been kind of an interesting diversion between those two pieces. And then, over the past 2 weeks, listen, I don't think we like to read too much into one indicator or 1 week's reading versus another week's. But I think it's interesting that folks responded so positively this reading.
John, Brendan, I assume the Fed. I'd like to think the Fed's reading our ESI, maybe not, but I assume they hate this reading kind of either way. Just kind of to wrap up this conversation, like what are they going to be looking for that might break this a little bit? I assume it's housing or used car, but like something big's got to kind of break to throw off this confidence a little bit and get folks to react to the interest rate hikes.
Yeah, I think the labor market really is where one place where the Fed is really focused, the tightness of the labor market. I've said before that they're trying to crack the labor market.
Right.
A bit of an overstatement there, but they certainly would. Weakening in the job market would give them some confidence that economic trends are going in the direction that they think, and that the inflationary impulse should follow. What's going to convince them about the can the Fed jawbone their way into traders into traders' minds that they're really not going to be cutting rates later this year? I think we wrote a piece on this called basically traders are from Missouri at this point. It's the show me state, right?
Yeah.
You got to show me. They're not going to believe it until the economy is slowing and the Fed is sitting on their hands saying, nope, we're not cutting. And that's, I think that is only after all these years since the global financial crisis, the mental model is the Fed always capitulates and rides to the rescue of the economy and the markets and so on and so forth. And I think that it's going to show, it's going to be that is going to be the assumption until the Fed proves them otherwise.
But I also think what we're seeing is just indicative of how dynamic the U.S. economy is, where, in the last 2 years, we've had a record number of small businesses start.
Right.
Also, the labor market's a great example. So crypto, you had a bloodbath. A lot of companies went out of business. Everyone's laid off. All the smart engineers just went, and now they're working on AI.
Immediately found a new job. Yeah.
Immediately found a new job. And this is an industry that's in, like the first inning in terms of, where we're going. So there's just a lot of really cool dynamic things going on that actually really isn't particularly reflexive to higher rates. Boeing just got a massive order for new planes from, what was it, India, John?
India,
so
yeah.
Do you think Boeing's not going to build those planes because the Fed keeps hiking rates? No,
right.
They're going to build them.
Right. And it harkens back that we're all operating off of the data and the readings we've always used coming out of like a pretty unique economic shock that was COVID.
Yeah, we kind of don't talk about that anymore.
Yeah, but it's still like we're in the first inning of like getting out of this Wild West.
Yeah. And especially in terms of inflation. I feel like we've stopped talking about, we're talking like inflation is just in a normal,
not that we shut down a global
out of
economy.
a pandemic. So it's going to be a little choppy and weird and confusing.
Yeah, totally. Well, let's take a little break there. And then when we come back, I want to get your thoughts a little bit on Biden's new team that's going to help him get through those choppy waters. And we'll talk a little bit about China and what's coming up next week. So we'll be right back on the Macrocast.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
We're back on the Macrocast. Bryan DeAngelis here, as always, with John and Brendan from Markets Policy Partners, and my colleague Oliver joining us this week on some of the consumer data. Guys, I want to get into some economic staffing news, if you will, this week. So Biden named Lael Brainerd as his new director of the National Economic Council. He also tapped Jared Bernstein to come in as CEA chair. Interesting move in my mind. I mean, not uncommon to see Biden kind of pick the new team as he moves into a phase of more implementation and regulatory work than necessarily like pushing new policies and legislation, but somewhat move into the political world for Brainerd, and it opens up a big question of who's going to take her spot over at the Fed. So would love to get
exactly, because Brainerd has been on the dovish side. So you will replace her with somebody, similar, but that takes a while. So it's going to be a number of meetings that her spot is going to be empty and her vote just won't be there.
Yeah.
What are you hearing, Brendan? Is Austin Goolsbee is the rumor? Is that right?
That's the one of them. So he just got named Chicago Fed. So
yeah, that'd be a pretty quick jump.
And he was a big part of the Obama administration. So he would be wonderful. But Brian, you had a couple other names, didn't you?
Yeah, he's definitely the front runner, but you saw some interesting reaction on the Hill. I think folks really like him, respect him on the Hill coming out of Obama era, but there's the normal push. Senator Menendez out of New Jersey is really pushing for a Hispanic voice to be added to the Fed. You've got some of your normal cast of characters pushing for a very pro-labor voice. So we're seeing names: Mary Daly, Susan Collins, Betsy Stevenson, few Romer, who folks on this podcast will know quite well, coming up there. I still feel confident Goolsbee can certainly get the votes. What'll be interesting is, how much pressure Biden's own party puts on him to kind of pick one of their favorites.
But that is interesting because there is a void of Hispanic voices within the whole Federal Reserve system. They've done a fairly good job of balancing it on other options. So that might I think Menendez should probably, make a stink about this one.
He did, and he makes a stink a lot. And, and Biden does have to listen to him from time to time for sure. And Biden's team seems to be very kind of thoughtful on this type of dynamic. So I wouldn't be surprised. I don't want to say Goolsbee was a trial balloon. I mean, he's too serious to call him that, but they're definitely trying to figure out if they can get him or how much heartburn they're going to get from their own side on it.
Yeah, and there's a lot of speculation about, the Brainard's move. Obviously, the position she had at the Fed is one of those that you tend to hold on to for a pretty long time. Yeah. And moving into the chair in the White House, that's not a seat people stick in for very long. And so the concept is this kind of a way station, another move for her as she goes back to the Treasury Department. When I was at the Treasury Department before the 2016 election, she was essentially picking out the furniture in the Treasury Secretary's office. Yeah. And so that has always been a place where her nameplate is already probably printed somewhere in the building. And so that is kind of the speculation that this is a one-stop move to replace Janet Yellen when Janet decides that it's her time to leave the Treasury.
Yeah, it's maybe felt that way to me.
Yeah, because Brian Dees played a pretty big role there. Whether you agree with it or not, that's a void that needs to be filled. And Lael Brainard is probably one of the few people here in D.C. that they could probably step in fairly easily and fill that void, especially as we're going into what it guarantees to be a very difficult negotiation on the debt ceiling.
Yeah, totally. And I don't know, you guys tell me if I'm got the wrong read on this, but I do think it puts her in that political boxing ring that probably you don't get so much at the Fed, but you certainly get as Treasury Secretary. So this does feel like a little bit of a warm-up match before she moves into that big job. Yeah.
Obviously, Democrats have to win the election, but if they do, she's certainly going to be.
We got 2 more years. I don't know. You think Yellen's there until the end? We'll see.
No. Yeah, I think Yellen is very happy to help and do the next 2 years, but I don't think she wants to keep going.
Right.
Ron, I have a question. I have a question for you, actually. So I guess, Brainard's going to have her work cut out for her at the White House. I think there was some polling earlier in the year around the credit that folks are not giving the White House for the various kind of positive news out of the economy. I think there's, in addition to the policy piece, there's a communications issue that the White House has around their economic message. What do they have to do?
Yeah, they need to obviously keep communicating on this and communicate strong. I mean, I think they went into this administration with a strategy to run the economy very hot. And they're doing that. The inflation is obviously the big problem with that and the easy target for Republicans and other opponents to go after them on. But you see them out there, every jobs number, the consumer feels strong. Rouse had a great op-ed, I think on CNBC this week, like really touting these numbers. They're doing the right thing of like, inflation's still there. I see the problem, but again, going back to the beginning of our conversation, like the inflation numbers, depending on how you look at them, are getting better in some ways. There is some easing, not nearly enough. They can't give up on that and cheerlead too much. But I think if they keep seeing that go down while they're seeing a great labor market, they're going to have a pretty strong economic message going into that.
Another dynamic that's been very interesting is Republicans hammer the inflation issue, and they blame the spending, the infrastructure and the Inflation Reduction Act. But the one thing that Democrats, I think, really missed an opportunity with was having the permitting at the federal level. They didn't get that. So it's still at the state level. And if you look, the Republican states, the red states that have lower regulations, have really taken up the infrastructure spending. So Georgia, has greenlit like 3 huge $1 billion projects, and they're spending this money. They're very happy about it, but they don't want, here in DC, they don't want the Democrats to know about that.
Right.
Although you did have Biden and McConnell open that bridge in Kentucky. I thought that was an interesting.
Yeah, you can't hide it. So that money's getting spent on really good projects, and people are happy about it. But the way the politics play, you're not gonna talk about it here in DC.
We're gonna see that's gonna be the story of these next couple of years leading up to the presidential election. Biden in a hard hat, ribbon cutting.
100%. Yeah.
Brainer's gonna be out there doing the same thing. Buttigieg, get the hard hat on, and
and it's gonna be really hard, to Oliver's point, for those like local Republican members to skip that groundbreaking. Like there's too many jobs, there's too much money.
And it's also stuff that was crumbling, and so I think the citizens are pretty happy that I'm not going to die on this bridge.
Always
our bridge infrastructure is horrifying.
It's horrifying.
I don't like going over bridges.
I worked on legislation with Dodd and Hagel 15 years ago on this. It's amazing how much we've neglected it forever. Let's take a big topic jump. Brendan, tell me a little bit of news out of China this week. Some sanctions against our defense companies. Just give me a quick take on that.
Before I have to ask a question: does China not have satellites? Like, why do they need balloons to spy on us? Like Google Earth, like you can zoom into my backyard and see, what color basketball it is. Why do they need balloons?
I mean, I don't support this, but I think it got to Montana before anyone noticed, and we noticed a whole bunch before that. Something worked. Yeah.
So obviously, our relations hadn't been very good, but we did kind of see some signs of easing recently after the Xi's coronation, and this balloon is definitely thrown a wrench in that. We also are ramping up, and that is happening here in DC. And that's a bipartisan issue, and we might get some legislation here on TikTok. But we're putting hard sanctions on Chinese tech firms, and they retaliated this week, putting sanctions for selling to Taiwan on Raytheon and Lockheed Martin. So the game has begun, and we're going to keep going. Biden is supposed to still meet with Xi, and then our Blinken, I think, is still on to talk to his counterpart in China.
Yeah.
Just a last word on China. We've been flagging to our clients that Chinese tales of Chinese stimulus, have been a lot of narrative and not a lot of oomph over the last few years. And our expectation is for that to replay this time. We thought that it was fair to have a rally. The Chinese markets have been really beaten down. And they get out of COVID zero, which is net that's a positive. But on the other side, the idea that you're going to have a real campaign of fiscal spending that and bank lending that really picks the economy up off the ground and puts it at a higher equilibrium or a significant uptrend. We don't think that that's the case. Looking at copper prices rolling over, looking at the way that oil prices are trading right now, oil prices are, down in the doldrums, in the low 80s, I guess, and high 70s in WTI. That's not flashing, China is back, baby.
No, you're right. And like today they announced, they are doing easing measures and they're putting money into the economy, but it's not to stimulate. It's try to, the economy is incredibly slowing. It's a very weak economy, especially because of the real estate, and they're just trying to keep things stable, not necessarily accelerate them. Though, John, did you see today? Apparently, that China's biggest banker is missing. No one knows where he is.
Well, it's being a billionaire in China is a very risky proposition. And
part of the rally in the market was hopes that the crackdown on the tech sector was over, and I don't think it is.
Well, maybe the crackdown on the tech sector is over, but it's just a rolling campaign.
Yeah, now into
that's a tame. Yeah, if you're a private sector actor that's getting too much power underneath you, you're obviously in the crosshairs of Beijing and leadership. It's something that investors had for years sort of glossed over, the idea that the big Chinese companies that they love to invest in have no property rights or any rights whatsoever except what the Chinese Communist Party decides to grant them. And the idea was always they could always hide behind this idea of, well, they wouldn't do that. They wouldn't strangle the golden goose. Their incentive structure is for them to support the private sector. Well, that ship has sailed, and so I think that's a paradigm shift in people's orientation toward investing in China that I don't think is going to change, and I think is more realistic than the previous one.
Yeah, it still surprises me, at least in my opinion, the overextension, I think, of just going a little bit too far on the part of Xi, with U.S.-China relations in particular. I mean, I don't, I guess Blinken will go over there and meet somebody, but the thing that I wonder about is, like, what is the off ramp? I mean, you had a high-ranking Pentagon official that's going to go to Taiwan. You have McCarthy that's probably going to go to Taiwan.
Right.
I mean, there's just where's the room? You have bipartisan.
The off ramp is when China invades Taiwan. They've told us they're going to do it. It's just a question of when it happens.
Yeah, well,
it's not an off ramp. We're just going to crash into a wall.
We're going to crash. Yeah. On that note, let's wrap this up. We'll have to tackle that another episode. John, do you want to close this out with what are we looking forward to next week?
Next week we have the macro calendar is a little bit lighter, but we do have another inflation number, the Fed's former preferred inflation metric, core PCE prices. They haven't really referenced that too much. It doesn't fit the narrative. It tends to be a little bit lower. But we'll see if they warm up to that one again. That comes in alongside spending and income data for the U.S. We've got the Fed's February meeting minutes, as if we weren't getting enough Fed speak and signals. We've got the minutes coming out. Global Purchasing Managers Indexes, the PMIs around the world for February. These are the preliminary February readings, and that'll give us a little bit of insight on this very muddy global growth picture. And other than that, earnings season's pretty much done. And what was kind of a mixed bag, but no smoking gun for a recession. So that's that's about as par for the course, I guess, on that front.
We'll stay relaxed in our seats as we touch down for a couple more weeks at least. But thank you guys. Always a pleasure. Great conversation. And thank you to all of our listeners for tuning into another episode of the Macrocast. Again, I'm Bryan DeAngelis with Penta, John Fagan, Brendan Walsh of Markets Policy Partners. Our guest today, Oliver Edelmann. Thanks for joining us. And remember, you can subscribe, follow us wherever you get your podcasts. Otherwise, have a great weekend. We'll see you next week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.